Welcome to The Explainer. Today we're tackling the strategic market view, massive earnings growth versus serious macro risks.
So, how exactly is the stock market completely brushing off major global threats like war and inflation?
The answer is here. S&P 500 first quarter earnings growth just surged to a massive 27.2%.
Just 3 weeks ago, estimates set at 12.5%. This dramatic leap upward changes the entire macro outlook.
And it's not just tech anymore. Growth is broadening significantly, driven by heavyweights in communication services and financials.
Thanks to giants like Alphabet and Meta, communication services alone is driving huge upside surprise for the market.
Even top-line revenue reflects this underlying health. All 11 sectors are currently delivering solid sales growth.
But here's the crucial question. How does this growth hold up against surging oil, inflation, and looming conflicts?
Despite these intense pressures and zero expected rate cuts this year, bond yields actually remain remarkably well behaved. Still, with the market trading at a lofty 21.1 times forward earnings, is it severely overvalued?
Let's compare. That raw PE looks high, but factoring in rapid EPS growth, the PEG ratio is just 1.05.
A peg near 1 suggests fair value. This mathematically justifies market resilience and heavily limits serious overvaluation fears.
Looking ahead to 2026, earnings per share estimates have already climbed to $328, reinforcing this resilient valuation.
Now, tactically speaking, the market is definitely overbought short-term. We are clearly due for a technical pullback. However, these robust, broadening earnings are acting as a powerful fundamental shield against geopolitical and inflation risks.
The trend is your friend until that earnings narrative explicitly fails. As investors, we must remain highly vigilant.
So, are you strategically positioned for this broadening growth or bracing for a sudden fundamental narrative shift?